When a nation collapses, most people imagine chaos. Riots, empty shelves, collapsing banks, families losing everything. But what if I told you there is one group? A group that never loses. A group that somehow walks away richer every single time a nation falls apart? Not once, not twice, but across centuries of empires, kingdoms, democracies, dictatorships, the same pattern repeats. When nations collapse, one group always wins big. But who are they? What do they know that ordinary citizens don't? And how do they turn national tragedy into generational wealth? Tonight we go deep into the mechanics, the history, and the financial architecture that silently transfers wealth during collapse. Because the truth is this: economic downfall isn't random, and wealth destruction isn't equal. Collapse has beneficiaries, and their wins are baked into the system. Let's begin. To understand how a small elite group profits when nations fall, we have to start where the pattern began. Long before modern banking, long before stock markets, long before central banks. We travel back to ancient Mesopotamia. Here, in the world's first economies, kings rose and fell. But one class always survived: the debt holders. When harvests failed and kingdoms weakened, farmers lost land. Soldiers lost wages. Armies dissolved. But lenders? They ended the collapse owning more land, more power, and more influence than before. This wasn't a coincidence. It was a formula. The same story played out in ancient Rome, the Islamic Golden Age, the Medici banking dynasties, the Dutch and British empires, and even the modern United States. Each time, when nations shook, when currencies collapsed, when ordinary people were wiped out, the same group walked away with more. But what exactly are they leveraging? What mechanism ensures they win when everyone else loses? We'll get there, but first, let's trace how this system evolves. Our story takes a dramatic turn in the 14th century, with the rise of the merchant bankers of Florence. The Medici, they discovered something powerful. When a country is unstable, its assets become cheap. And when assets are cheap, the powerful buy. Wars, droughts, plague outbreaks, all created sudden collapses in public confidence, followed by fire sale prices for land, gold, trade rights, and debt. This wasn't simply luck. It became a strategy. And as Europe moved into the Age of Empires, another group evolved this strategy even further. The East India Companies, the world's first multinational corporations. Every time a colony revolted, every time a kingdom defaulted, every time an empire drained its treasury, elite financiers stepped in to rescue them, at extreme interest or in exchange for mining rights, trade monopolies, military access, tax privileges, land ownership. Collapse wasn't a problem. It was an opportunity, one that only a small elite knew how to exploit. The mechanism was becoming clearer, but the modern version was still on the horizon. And it would arrive with the invention that changed everything: centralized global banking. Fast forward to the 19th and 20th centuries. Nations were now more interconnected. Money could travel faster. Banks became larger. Markets more complex. But something far more powerful emerged: crisis-engineered wealth transfer. A system where collapses could be anticipated, exploited, accelerated, or even created, and only one group had the access, the information, and the capital to position themselves ahead of time. Let's break down the three core pillars of the mechanism. Pillar 1. Liquidity control. When a nation grows weak, its liquidity dries up. Loans become scarce. Cash disappears. Businesses suffocate. Who controls liquidity? Banks. Who controls banks? Central banks. Who influences central banks? Private financiers and political elites. By tightening credit or raising rates at the worst possible moment, liquidity is intentionally choked, causing business closures, mass layoffs, market crashes, asset price collapse. When prices fall low enough, guess who buys? The same group that helped trigger the scarcity. When a nation grows weak, its liquidity dries up. Loans become scarce. Cash disappears. Businesses suffocate. Who controls liquidity? Banks. Who controls banks? Central banks. Who influences central banks? Private financiers and political elites. By tightening credit or raising rates at the worst possible moment, liquidity is intentionally choked, causing business closures, mass layoffs, market crashes, asset price collapse. When prices fall low enough, guess who buys? The same group that helped trigger the scarcity. Pillar 2. Debt leverage. Debt is the most profitable product in human history, and during crisis it becomes a weapon. When nations collapse, debts cannot be paid. And when debts can't be paid, lenders seize assets, ports, natural resources, industries, utilities, farmland. This is why, after nearly every sovereign default in the last 200 years, ownership transfers upward. Every collapse has a moment, a trigger that turns instability into disaster. It might be a sudden interest rate spike, a currency devaluation, an unexpected policy change, a banking failure, a geopolitical shock. But behind the scenes, one striking pattern appears. The powerful exit early. The public exits late. Let's look at 3 powerful historical examples. Example 1. The 1929 crash. Major financiers quietly sold stocks months before the crash. Ordinary people bought in, believing the boom would never end. When the market collapsed, citizens lost life savings. Businesses collapsed. Unemployment soared. Poverty exploded. But wealthy insiders? They bought stocks at historic lows, multiplying their wealth as the market recovered. Example 2. The 1997 Asian financial crisis. Western hedge funds placed massive bets against Asian currencies before governments knew what was happening. When currencies collapsed, national wealth evaporated. Millions lost jobs. Savings were destroyed. Meanwhile, the same hedge funds recorded some of the largest profits in financial history. Example 3. The 2008 global meltdown. Insiders packaged toxic assets, bet against them, triggered collapse, and then profited from the collapse they caused. When the dust settled, 10 million Americans lost their homes. Banks received trillion-dollar bailouts. Executives received record bonuses. Collapse had rewarded its architects. We often hear that recessions destroy wealth, but that's not true. Recessions transfer wealth. Here's how. 1. Asset prices collapse. Stocks, land, houses, commodities, everything becomes cheap. 2. Liquidity returns selectively. Banks begin lending again, but mostly to large investors, not ordinary people. 3. Recovery begins. As the nation stabilizes, the new owners, the elite, own far more than before. This is why billionaires increase their wealth faster during recessions than during economic booms. Collapse isn't destruction. It's consolidation. Governments attempt solutions, stimulus, bailouts, monetary easing, austerity, tax reforms. But none of these address the core mechanism. Those who design the financial system are the same people who benefit from its failure. The fox guards the henhouse. The architect profits from the collapse of his own design. This is why reform fails repeatedly. The system isn't broken. The system is designed to work this way. The collapse profit cycle is not a glitch, it's a feature. Section 7. Modern parallels. The pattern hasn't stopped. The pattern didn't end in the past. It's accelerating. Consider these facts. During the 2020 pandemic, billionaire wealth increased by $3.9 trillion while millions lost jobs. In multiple countries today, inflation rises while wages stagnate, widening elite wealth. Housing crises around the world are followed by major investment firms buying thousands of homes at discounts. Crypto crashes wiped out millions of small investors while early insiders cashed out at the top. Global debt is now a record $313 trillion. Ensuring future collapses will be even more profitable for creditors. The pattern repeats. The same group wins again and again. Which brings us to the key question. What can we learn? Takeaway 1. Collapse always follows a predictable pattern. Liquidity tightens debt, expands confidence, breaks prices, crash elites buy everything cheap. Understanding the pattern is the first step to protecting yourself. Takeaway 2. Information is the real wealth divider. Early information equals profit. Late information equals loss. The timing gap is the engine of elite wealth. Takeaway 3. Ownership determines survival. Those who own assets recover. Those who own nothing suffer. This has been true for 5,000 years. Final warning. Closing message. History is clear. Nations collapse. Systems fail. Currencies die. Empires crumble. But the collapse itself isn't the end. It's the beginning, the moment when the greatest transfers of wealth occur. And unless people understand the mechanism behind collapse, they remain its victims. So the real question isn't whether a future collapse is coming. It's who will be positioned to benefit when it does. Because as history shows, when nations collapse, one group always wins big. The question now is, which side will you be on?